Okay, let's unpack this. Today, we're diving deep into some fascinating insights about the recent tariffs imposed by the U.S. on India, especially with that 24-hour deadline that loomed over everything. Our mission is to cut through the noise, understand what these new policies mean for various industries, and uncover where the immediate challenges, but also surprising opportunities, lie for you. We'll be navigating through the latest updates surrounding that India faces 24-hour deadline situation, breaking down how this impacts different sectors one by one. So let's set the scene. What exactly happened on August 1st, 2025?
Right. On that day, the U.S. effectively imposed a sweeping 25% duty on a very wide range of Indian exports. And it wasn't just about direct trade either. There were also these explicit threats of secondary tariffs, essentially duties on goods from countries trading with sanctioned nations like India, potentially buying Russian oil. If you look at the numbers, roughly half of India's nearly $86 billion in annual exports to the U.S. are now facing these higher duties. That's a big chunk.
A big chunk indeed. So what does this actually mean for the Indian economy right away? What were those immediate ripples we saw?
Well, analysts were quick to warn about a squeeze, particularly on labor-intensive industries, and, a potential shave of maybe a few tenths of a percentage point off India's GDP. Immediately, the market reacted. The rupee weakened. Export stocks definitely took a hit. But here's where it gets interesting. Most economists actually believe the macro effect, the big picture effect, will be limited. For instance, the PHDCCI, that's the Punjab, Haryana, Delhi Chamber of Commerce and Industry, they estimate only about a 0.19% hit to GDP.
0.19. That seems quite low given the circumstances.
Right. It does. And this seemingly small number is actually a critical insight into India's economic resilience. It really underscores its strong domestic consumption and, frankly, less reliance on exports compared to somewhere like China. It tells us the core growth engine is largely internal, offering a different kind of stability. There's also this background expectation, that these tariffs might very well be negotiated down later, but it really highlights that the impact is highly specific, sector by sector, not broadly catastrophic. Selection is key here.
That's a crucial distinction. Limited macro effect, but potentially sharp micro pain in places. Okay, let's delve into those specific industries then. Which sectors are expected to feel the most significant pressure? Where's a real heat?
Exactly. We're seeing intense pressure on several export-oriented, labor-heavy industries. First, think about labor-intensive consumer exports. This includes textiles and apparel, gems and jewelry, and leather and footwear. India's biggest exports to the U.S. are actually in garments and fabrics. We're talking over $5.6 billion of its global apparel exports heading to the U.S. So a 25% tariff, it just completely erodes India's pricing advantage.
Wipes it out, basically.
Yeah.
Makes them 25% more expensive overnight.
Precisely. And major exporters, names like Wellspun, Gokaldas, they've already warned about order cancellations delays. The Gems and Jewellery Export Council, for example, they explicitly stated that a 25% duty will inflate costs, delay shipments, and place immense pressure on their whole supply chain. And that's huge when the U.S. market represents nearly $22 billion for Indian diamonds and jewelry. We're also hearing that many MSMEs, the small and medium enterprises in leather and footwear, are petitioning the government for relief. They're worried about lost orders, even factory closures.
Right. These are definitely industries where even a small price hike can kill a deal.
Yeah.
Are there other sectors in a similar, very tight spot?
Yes, there are. Next up, you have to consider marine products. We're talking shrimp, seafood. Around 48%, almost half of India's shrimp exports go to America. So these tariffs just directly eat into the margins for Indian exporters. They either have to absorb the cost or cut prices. It's a real challenge in their dominant market.
Okay, shrimp too. And what about the heavier side? Industrial goods, components, machinery? How are they faring?
For industrial and capital goods, that includes engineering, auto components, electrical and mechanical machinery. The impact is also very tangible. India exports machinery and auto parts, from companies like Part, Forge, Motherson to the U.S. And they'd already been hit by an interim 26% tariff before this. So these new duties just make Indian engineering and machinery exports even costlier. They risk losing contracts to other suppliers. This segment shipped about $9 billion worth of electrical and mechanical goods to the U.S. So higher duties directly squeeze profits and, frankly, make investing in these exporters riskier right now.
We've covered quite a range there, quite a few vulnerable sectors. What about chemicals and pharmaceuticals? They often seem to occupy a unique space in these trade talks.
They do. While maybe less labor-intensive, they are still very export-oriented. The U.S. buys about a third of Indian generic drugs. That's roughly $9 billion a year. Now, the report suggests many pharmaceuticals are actually exempt from the current August 1st tariffs. But, and this is a big but, uncertainty remains high, especially since Trump has explicitly hinted at potential future tariffs on drug imports. And for specialty chemicals with U.S. customers, similar risks are definitely looming if duties get imposed later. So it's a sector to watch closely, even if it's not feeling the immediate burn like textiles or gems.
Okay, so in essence, it's the labor-intensive consumer good garments, jewelry, leather, plus marine products, and industrial machinery suppliers who are currently the most exposed. They're facing near-term order losses and serious price pressure. But as you said, it's not all grim news. Let's shift focus. Where are the opportunities? Which sectors are showing resilience, maybe even thriving amidst these trade headwinds? What's the compelling story on the flip side?
Right. And the striking thing is there are several Indian industries that are relatively insulated or even stand to benefit from these offsetting global trends. Let's look first at tech and electronics manufacturing. Many of their exports computers, smartphones, are either exempt or less exposed. And crucially, global supply chains are shifting. You hear about the China plus one strategy all the time. Companies want to diversify production away from China, and India is a prime beneficiary. We're seeing Apple shipping the majority of its iPhones to the US from India now. Google's putting $6 billion into Indian data centers. Tesla's introducing cars there. These aren't small bets. They highlight India's growing appeal as a tech manufacturing hub, helped by government incentives and, frankly, competitive wages.
That does sound like a powerful long-term trend. What about the services side of tech, though? IT services.
Absolutely. IT services and software are structurally pretty much unaffected by this. India's service exports, IT consulting, software development, they just aren't subject to these merchandise tariffs. So the big IT firms, TCS, Infosys, HCL, they aren't directly hit by these duties. Their earnings depend more on global tech demand, not specifically U.S. trade policy. So they're seen as strong defensive plays when trade jitters hit the market.
It really sounds like domestic demand is acting as a massive buffer for quite a few sectors. Can you expand on those a bit more?
Exactly. Domestic-focused industries are proving very resilient indeed. This covers a lot: consumer staples, financials, infrastructure, even agriculture. Companies serving India's huge domestic market, they can largely ride out these global trade squabbles. Staples like FMCG, food, household products, they depend on local consumption growth. The banking sector isn't directly tied to exports. Plus, the RBI, India's central bank, is likely to ease policy to support growth, which could boost credit. India is also spending heavily on infrastructure, roads, railways, power. That keeps demand strong for cement, steel, construction. Even the large agrarian economy is mostly insulated. These tariffs on merchandise trade don't directly hit farmers or rural spending much. And you see rating agencies like Fitch and Moody's stressing this point. India's economy is much less trade-dependent than China's. That domestic strength is a huge factor.
So that internal engine really acts as a shock absorber. Interesting. What about sectors benefiting from bigger strategic shifts or maybe unique resource situations?
Yeah, that brings us to what we can call strategic and resource-driven sectors. Take energy and natural resources. Pure oil and gas producers are somewhat insulated. They sell into global markets anyway. And actually, many have benefited from cheaper feedstock because India significantly ramped up imports of discounted Russian crude and naphtha. These energy products were exempt from the U.S. tariffs too, and that flows directly into chemicals and petrochemicals. They have this unique tailwind right now. India importing cheap Russian naphtha is dramatically cutting costs for petrochemical firms. Analysts, like those at SMC Global, point out this cheap naphtha brings down input costs, helping Indian producers undercut Chinese competition. India might even become a net exporter of things like naphtha and plastics. Companies like Reliance, UPL, they could see higher profits from this, helping offset pain elsewhere. And finally, you've got defense manufacturing. The Indian government is really prioritizing a self-reliant defense sector, encouraging joint production deals. That Russian naphtha connection even helps here, supplying plastics and resins for things like airframes and drones. So companies involved in aerospace parts, missiles, defense electronics, they could see solid growth as India relies more on domestic suppliers.
Right. In essence, then, the resilient or opportunistic sectors are those plugged into strong domestic demand or benefiting from these strategic tailwinds, like the China plus one shift or cheaper inputs. And the fact that global giants like Apple, Google, Tesla are still investing heavily suggests technology, manufacturing, and infrastructure remain strong magnets for capital. Now let's zoom in specifically on pharmaceuticals. You mentioned it earlier. It feels like it's in a bit of a gray area. Highly export dependent, especially to the U.S., but largely spared so far. So is it a safe haven, or is there a hidden risk we need to understand?
It's definitely a watch carefully, selectively invest kind of sector. You're right. India is the world's largest generic drug provider, exports over $25 billion annually, and a huge chunk, maybe 35–40%, goes straight to the U.S. We're talking about household names in India like Sun Pharma, Dr. Reddy's, Cipla. Let's break down the nuances. Currently, yes, most pharma products seem exempt from the August 1st tariffs, so the immediate hit is low. However, the threat of future tariffs is real. Trump explicitly mentioned drugs, blaming unfair trade. An America First drug pricing policy could also force price cuts on imported generics, hitting margins indirectly. But then there's the ever-present FDA regulatory risk, warning letters, facility bans, these have happened before, and there's even an indirect exposure to those secondary tariffs we talked about if sanctions target banks or buyers involved with Russian oil, which India uses for some drug feedstocks. Compliance costs could rise.
So significant policy and regulatory clouds potentially on the horizon. Why would investors still look at this sector then? What's the bull case?
Despite those risks, there are compelling reasons to still consider select pharma stocks, especially long-term. First, cost leadership. Indian firms often offer prices 70–80% lower than Western producers. That makes them incredibly hard to replace. Second, U.S. dependence on India. Roughly 1 in every 3 drugs sold in the U.S. is made in India. You can't just switch that off overnight. Third, the China +1 gains are very real here too. Global pharma majors are diversifying sourcing away from China, and India is a major beneficiary, with API and intermediate facilities expanding fast. Fourth, Indian firms are moving up the value chain: biosimilars, complex generics, injectables. These tend to be less exposed to simple tariff pressures and have higher margins. And finally, the Indian government's own PLI scheme is actively incentivizing local API and formulation manufacturing, which reduces long-term import dependency and costs for Indian companies. So how do analysts see it? Short term, maybe avoid too much exposure to low-margin exporters heavily reliant on the U.S. medium term. Focus could shift to R&D-driven players and API producers benefiting from China +1. Long term. The view is India will likely remain the pharmacy of the world. Any Trump-era disruption is probably temporary or something that gets negotiated. So the bottom line for pharma is selective accumulation. Don't shun the whole sector, but perhaps prefer diversified, R&D-focused, globally oriented players. And definitely keep an eye on U.S. policy moves.
That's a really great breakdown of the nuance there. Okay, let's try and bring this all together now. We've mapped out sectors under pressure, sectors showing resilience. What's the overall trade-off here? And critically, what does this mean for you, the listener, trying to make sense of the market right now?
Well, the near-term risks are definitely clear. Tariffs and the surrounding uncertainty could slow India's growth by, as we said, maybe a few tenths of a percent. Exporters will see order cutbacks in affected sectors. Currency volatility might continue. The rupee did hit new lows recently. And, sentiment-driven sell-offs can sometimes spill over, even hitting unrelated sectors briefly, like we saw with IT initially. Plus, there's always that background risk of escalation, particularly around secondary sanctions on Russian oil buyers, which could create banking or logistical headaches for Indian refiners. However, these risks are balanced, maybe even outweighed, by significant offsets. Remember, the rating agencies stressing India's resilience due to its large domestic economy, much less trade-dependent than China. Ironically, the fact that U.S. tariffs on India might end up lower than those on China or Vietnam could actually help India attract manufacturing investment in the longer run. And many experts, including analysts at places like Goldman Sachs, believe these tariffs will eventually be negotiated lower. They see the main downside coming from the uncertainty itself, rather than a fundamental economic collapse. Crucially, India isn't just sitting still. It's actively diversifying its export markets, pushing more into Europe, the Middle East, and Africa for goods like garments and electronics.
Okay, so given those converging forces, the headwinds and the buffers, how should someone approach this situation strategically?
I think for long-term investors, this really points towards a strategic reweighting approach. You might consider avoiding or at least underweighting those clearly targeted exporters. That's your textile mills, gem and jewelry units, leather footwear makers, shrimp farms, industrial exporters heavily reliant on the U.S. They face tangible headwinds to their earnings right now. Conversely, you could look to overweight or hold companies primarily driven by India's strong domestic growth story or those benefiting from these new strategic trends. Think IT services, telecom, consumer staples, banks, energy, defense, maybe even those chemical companies getting the NAFTA boost. These businesses are likely to deliver steadier earnings regardless of the U.S. trade rhetoric. Specific opportunities might lie in industries gaining directly from things like the cheaper naphtha imports, so petrochemicals, plastics, or from continued U.S. capital inflows into areas like tech manufacturing and data centers. These could potentially offer outsized returns. Some industry analysts are even suggesting using this market correction as a chance to buy good quality companies that have perhaps been oversold in the panic, viewing the current tariff shock as likely temporary. Markets might re-rate these names if a trade deal or tariff rollback happens down the line.
So what does this all mean for you as we wrap up this deep dive? We've painted a complex picture, haven't we? Immediate challenges for some, but clear long-term resilience and emerging opportunities for others. And this really raises an important question for all of us. In a world of constantly shifting trade dynamics, how do these short-term shocks ultimately reshape a nation's strategic economic future? And what does that imply for global diversification moving forward? Thank you for joining us on this deep dive. We hope this exploration has given you a clearer understanding of the many forces currently at play.
Just a final reminder, as always, this deep dive is for informational purposes only. We are not SEBI-registered financial advisors. If you are considering making any investment decisions based on this or anything else, please consult with a certified financial advisor who understands your specific situation.